All right, let's dive into something that's absolutely fundamental to how goods move around the planet: supplier's credit. Now, I know it sounds a little financial and maybe a bit dry, but trust me, it's actually a super clever solution to a problem that businesses face every single day. It's one of the key things that keeps the engine of the global economy humming.
So just picture this for a second. You're a business, right? You need to import a big shipment of, say, electronics. You'd love to pay for them after you've sold them because, cash flow is king. But your supplier, who's halfway across the world, is thinking the exact opposite. They've already spent money on parts and labor, and they need their cash now. It's a classic standoff, a real cash flow tug of war. So what do? How do you bridge that gap?
Well, that's where supplier's credit comes in. The best way to think about it, it's basically the buy now, pay later for global trade. It's a financial tool where the exporter, the supplier, agrees to let the importer pay down the road. But here's the really cool part, a little bit of magic. Thanks to the banks getting involved, the exporter still gets their money almost right away. It's this bit of financial wizardry that acts as the grease in the wheels of international commerce. Okay, so how does this whole thing actually happen? It's not just a simple handshake, that's for sure. It's more like a carefully rehearsed dance with four main partners and a very specific flow of goods, paperwork, and of course, money. Let's walk through it step by step. First up, let's meet the cast of characters. You've got the importer, that's our buyer who wants to hold on to their cash for as long as possible. Then there's the exporter, the seller, who understandably wants to get paid. And in the middle, acting as the essential go-betweens, are their banks. The importer's bank is the issuing bank. They're the ones putting up the guarantee. And the exporter's bank is the negotiating bank. They're the ones who are going to front the cash.
So here's how the dance plays out. It all starts with a sales contract. Based on that, the importer's bank issues something called a usance letter of credit. Just think of it as a rock-solid, bank-backed IOU that promises to pay, but on a future date. Okay, so once the exporter ships the goods, they take all the shipping documents, like the bill of lading, proof the goods are on the move, to their own bank. And now for the key moment. It's called discounting. The exporter's bank checks the docs, and if everything's in order, they pay the exporter right then and there, minus a small fee. Boom. The exporter has their cash, they're happy, and they're basically done with the deal. Months later, when the original payment is due, the importer pays their bank, and then the two banks just settle up between themselves. Pretty slick, right?
Now, you might have also heard of something called buyer's credit. They sound almost the same, but the difference is actually a really big deal. It all comes down to one simple question: who's in the driver's seat when it comes to arranging the financing? Let's put them side by side to see what I mean. So check this out. With supplier's credit, the financing is baked right into the deal the supplier offers. It's simple, it's clean. But with buyer's credit, the roles are reversed. The importer is the one who has to go out and arrange for a loan, usually from a foreign bank, to pay the supplier. That means the importer can shop around for the best interest rates, which is great. But the real kicker might be on the balance sheet. Supplier's credit just shows up as a trade payable, just another bill to be paid. Buyer's credit, though, gets recorded as short-term debt, and that can change how lenders and investors look at the health of your company. So, which one is actually better? Well, the truth is, there's no magic answer. It really depends on your business and your strategy. Neither one is perfect. They both come with a very specific set of pros and cons for everyone involved.
Let's look at it from the importer's point of view. The biggest pro is obvious: cash flow. You get your goods, you sell them, then you pay. It's fantastic. The catch? Well, since the supplier arranged the financing, they might just bake the cost of that credit into the price of the goods. You might be paying a hidden fee. Plus, you've got to worry about the currency exchange rate changing before you pay. Now for the exporter. For them, offering credit is a killer sales tool. It can make them way more competitive and help them land huge deals. And the best part? They turn a credit sale into immediate cash. The risk is super low, but it's not zero. In the very, very rare case that the importer's bank goes under, they could, in theory, be on the hook.
Now, with all this money and credit flying across borders, you can imagine that things need to be kept in check. This isn't the Wild West of finance. To prevent chaos and keep their economies stable, central banks around the world step in and lay down the law. And a great example is how the Reserve Bank of India, the RBI, handles it. In India, the RBI bundles all these kinds of arrangements under one name: trade credits. And supplier's credit is a huge piece of that puzzle. The RBI's rules are there for a reason. They want to control how foreign money flows in and out of the country, and make sure these credit lines are used for actual, legitimate trade, not just for speculating on currencies. So they set clear limits on pretty much everything. For example, for most regular import deals,
The RBI allows up to $50 million per shipment, and this falls under what they call the automatic route, which basically means businesses don't have to jump through a bunch of hoops to get special permission. That high number is there to make sure the vast majority of normal business can happen smoothly.
The RBI also gets specific about how long you have to pay it back. And this part is actually pretty smart. If you're importing capital goods, big stuff like factory machinery that's going to last and make money for a long time, you can get a credit period of up to 3 years. But for raw materials or other things that get used up fast, the period is much shorter, usually just 1 year. It makes perfect sense, right? The length of the loan matches the economic life of the goods.
And beyond the official rulebook, the banks themselves are on the front lines, acting as the system's watchdogs. They're constantly on the lookout for major red flags. Things like trade-based money laundering, which is a fancy term for crooks using fake invoices and prices to move dirty money. They also have to watch out for duplicate financing, making sure nobody is trying to finance the same shipment twice, kind of like trying to take out 2 mortgages on the same house. And of course, a huge one, they have to screen every single person and company involved to make sure they're not accidentally doing business with anyone on an international sanctions list. They really are the gatekeepers here.
So at the end of the day, supplier's credit is so much more than just a way to pay for stuff. It's a complex, global system built on trust that allows a small business in one country to use the financial power of a huge bank in another to grow. But as we've seen, the risk in these deals never really disappears. It just gets moved around, passed between the importer, the exporter, and their banks. And that leaves us with one big question to chew on. In this intricate global dance, who do you think is truly holding the most risk if things go sideways? Think about it.